to our Kenny and Kenny Best Practice Series. We've got a really awesome group of special guests who you'll meet shortly. Today, we're going to cover tax minimization for business owners through 401ks. This is one of the greatest vehicles for minimizing tax. You're deferring the obligation to the future and benefiting from the tax deferral on the gains as well. So with that, let's dive in. Again, this is part of our series. They're 30 minutes, so we're going to cover a lot of ground. The recording will be available on our website, and feel free to access. But just a quick legal disclaimer, we're doing our best to provide you with accurate, timely information. You're welcome to use it. If you're going to use it for your purposes, just ask that you let us know. A little bit about Kenny and Kenny. We're like to think of ourselves as your partner without equity. We work with all size businesses, and worthwhile plans take time to realize, and we try to create plans that fit our clients. So today's agenda, I'm going to introduce our special guests. We're going to look at 401k plan design options. Next, we're going to look at 401k investment and discuss those. And then we have time for a Q&A. So without further ado, I'd like to introduce Nick Guido with Chicago Partners, and Martin Jantzen with Jantzen Associates. He's a certified pension consultant, and then Susie Knight. So with that, let's start with 401k design options. Martin?
Okay, well, thanks, Tim. Just a brief overview. There's really two different types of retirement plans, specifically, one of which is a defined contribution plan. The other is a defined benefit plan. So defined contribution plans, generally in nature, the employee bears the risk of the investment. Those are things like 401ks, profit sharing plans, your SEP IRAs, and that sort of thing. So whatever the investment, if it goes up or down, the employee shares that responsibility. Defined benefit plan, such as a traditional DB plan or a cash balance plan, typically is a stated type of formula in which the employer bears the risk of whatever that is. So if the assets go up, it's all determined whether by an actuary on whether or not the employer needs to contribute and how much. If assets go down, then a higher contribution is generally due and that sort of thing. So that's really kind of the nature of the beasts, where you have one's a defined contribution and one's a defined benefit. Today, we're typically just going to give a brief overview of the defined contribution plans. And there's really two or three kind of models for the small employer market.
I'm sorry to interrupt, but is there when do these plans make sense for business owners to consider?
So the overall goal is really tax savings. And I think the CPA is best suited to be able to identify what makes sense for the individual client and to see where that kind of goes. Also, the secondary thing to take into account is, well, is it mandated? So like the state of Illinois requires any employer that's been in business for over 2 years and has over 5 employees that they have to have some sort of plan. Otherwise, you need to use the state plan. So generally speaking, the short answer is the CPA is the one to be able to kind of identify, hey, does this make sense for us to put deposits in so that it's a good shake on the stick and that sort of thing. Does that kind of answer the question in that?
It does. So if you've been in business 2 years or more, you're required to have that benefit. And then otherwise, it's more of a a tax planning decision and best suited for the CPA to help.
Correct. And part of that thing is it's an overall thing with the broker as well, because as a small business owner, typically they invest a lot of their time and money into the business and necessarily don't always have other avenues to diversify their assets. So you want to be able to hit certain goals and plateaus as part of not only the employee retention, but also your own personal as an owner to a company. You kind of want to look at how have I been progressing, not only on the business, but personal and all that. So it kind of hits many different emotional levels as well to be what most people want is to be self-sufficient when you retire, because the state of Social Security is always up in the air and you never know what we may or may not receive out of those programs.
Right.
So typically we're looking at, for the small plan market, you'll either have something as a SEP IRA, which is a straight percentage of pay, and you're looking at having to include basically all employees that have been employed 3 out of the 5 past years that make only $750. So that's a construct where if you're throwing a plan for an IRA, that you typically include everybody and anybody who's employed, and they'd all get the same percentage of pay, and that's how you would fund it. So typically that doesn't always make the best tax sense, but it is if you're, let's say, a sole employer and you only have an objective of X dollars, it's 25% of pay is what you're limited to that. And then something a little offshoot of the SEP IRA is like a simple 401k, where you'd have to include anybody who's worked over 2 years and made $5,000 or is anticipated to make $5,000 in the future year. Once again, that's an IRA funding vehicle. There's no 5,500 forms for something like that. But once again, you don't get a lot of flexibility with who you can include, who you can exclude, and the type of let's say percentage to the employees. So with a profit sharing or a traditional 401k, that's kind of the different thing. What we kind of hear talk about is the profit sharing plan allows you different formulas of percentage of pay that you could or may want to do as a tax planning tool. And as far as that goes, typically a 401k is just a feature of a profit sharing plan. And the things that you see most prevalent in the marketplace today is typically a safe harbor formula where we're not worrying about too many discrimination testing items. And that would normally require basically a 4% match to anybody who puts dollars in, or a 3% contribution to all and anybody if you go that route. And typically with a 401k, the profit sharing plan would be in addition to those sorts of things. And what you're seeing in a smaller plan market is a cross-tested or age-weighted one where you use the age and or comp of the employees to determine relative benefits. And typically the owner is most likely older and or more highly compensated, so you can tier things differently. For example, you might be able to put 25% of compensation to the owner versus, let's say, 5% to the rank and file employees. So that's a different construct. And then part of what you could do with a profit sharing plan is you can have a vesting schedule. When you use an IRA or a SEP, you have to give 100% vesting, where you normally would not need to do something like that in the 401k environment. Now, the downfalls of the 401k, obviously there's a little bit more administration with it, and you will have 5,500 filings. But go ahead.
So with the vesting schedule on the profit sharing, that kind of checks the box on basically promoting employees sticking around. Can you kind of share a little bit more about that? Because that's a big thing. I mean, when an employee leaves a company, there's a cost associated with finding a new employee and getting them trained on the intellectual capital with that business. So this kind of, in some respects, can offset some of that cost.
Correct. So that retention is really one of the main tools for the vesting. And what you normally would see is either a 3-year cliff, which is 0, 0, and 100% in the third year. And by years, we mean 1,000 hours of vesting, or depending on how you do it, you could also have a 6-year graded schedule where you 20% a year as what's called a ladder vesting. So it would vest over time. It's more popular in this day and age to really do a 3-year cliff, just because after an employee's been with you 3 years, there's been some sort of trial period where and most likely the employee knows whether they want to stick around or not. So that typically tends to be the prevalent vesting schedule today.
Yeah. So can you give us an example? So let's say that the company's put $10,000 in an account for profit sharing for a particular employee. They leave after, say, year 3 on a 5-year vest.
Well, on a 5-year vesting schedule, what you're typically looking at is an 80% vesting. So if the account balance was $10,000, the employee would get $88,000, and $2,000 would be forfeited and reallocated to the other participants in the plan.
So all the participants, rank and file, employees, owners, everyone.
Correct. So that forfeiture would go to reduce the allocation that particular year, or pay any plan expenses, depending on how the trust document's written.
Great. Yeah. No, that's great. Thank you.
And then some of the things with an actual 401k plan, there's tax credits where you get 100% of the startup costs for the first 3 years based on how many rank and file employees. Also, the Secure 2.0 is also including contribution credits over a 5-year period, typically about $1,000 per employee. And then you now have to have automatic enrollment, but there's a $500 credit that goes along with that. So there are some taxes, incentives that really are trying to make these plans more palatable to your small employers. The other thing that needs to also happen, with regards to a 401k plan, is you do need to have a fidelity bond. So if you have a rank and file employee, and typically that's a 3-year bond that costs $100 or so, depending on the size of your assets, and it's whatever the assets are at the end of the year, and the bond will generally ratchet up to that. So that's a requirement under ERISA to have that particular bond. And as far as I guess backtracking a little bit with plan objectives, I think ultimately the plan design is dependent on cost versus administration. And the more complex a plan is, the higher the cost of administration. For example, if you need to have specific formulas, actuarial stuff, those things then tend, if you have a highly ratcheted complex plan, administration costs go up. And the more simple the plan is, let's say a SEP or a cookie cutter formula, the more cost it is for the employer, because if you have to give the same percentage of pay to all employees, then that's an employer cost that you may or may not want to entertain. So the idea is really to try to find somewhere happy in the middle, where you get a plan that you can communicate well to the employees, that the employer understands, and kind of marries both. Does it work for the company, and am I getting a good tax deduction, so that at the end, it's not only something that the employer wants, but it actually benefits the owner. Because if a plan doesn't benefit the owner in positive way from a tax standpoint, there generally tends to be little, I guess, what's the word I'm searching for them to want to implement something that's not,
Motivation.
motivation to want to enter into these type of agreements unless they have.
Yeah, just my experience on that point is that you want it to have the attention of the business owner so that they pay attention to the plan because of the administrative requirements that, it's something that you don't just put it in place 1 year. It's something that continues and someone has to administrate that. So therefore, if there's benefit for the owner, then they'll pay attention to the plan, which I think is important in my experience.
And there's cost with the 401k profit sharing on the administration side. But if you adopt one that's free, like a SEP or Simple, basically the admin responsibility is on the owner.
Exactly.
Right, and then that actually goes to your point too. So if you end up with the Illinois Secure Plan, the employer is responsible for tracking all the hours. The employer is responsible for making sure the dates of hire, dates of birth. So some of the things that you would normally have a TPA keep track of now become more on the employer. So in certain instances, it's actually a time saver for the employer to adopt a plan that's not state driven.
They have someone like you involved, Martin, to keep everything straight.
True. So we have all the software and expertise for that to happen for you.
Right. Well, now that we've talked about plan design, let's shift over to investment options. And for that, we've got someone who's very well versed in that, Nick Guido with Chicago Partners.
Thanks, Tim. Appreciate the introduction there and appreciate everyone joining us today. So as Martin had said, there's obviously a plethora of different plan types and plan designs that each individual and their firm should explore and look for and identify what is best for their needs. But each of these kind of offer a unique opportunity from an investment perspective in our mind to not only help from a growth aspect, but also help from a tax perspective as well. So what we see a lot is that, these 401k plans are set up and there's really two options with 401k plans, especially for smaller business owners, is you can either have them be self-directed or you can go the traditional route of an investment lineup. If you go the traditional route of an investment lineup, you're going to have your target date funds and you're going to have, your traditional options within those plans. And those are great for larger plans. But what we like to do is actually engage with those business owners and help them be in the self-directed option, because that opens the entire investment universe to you as an investor in that plan. That's important in our mind because we don't like to look at portfolios in isolation. We're not just looking at your 401k account or just your taxable assets. We like to look at everything holistically. And by having that 401k plan, it allows you, if you have fixed income investments in your portfolio, to locate them in a 401k plan rather than in a taxable account. That will help you save on taxes, because now when those distributions are paid from those fixed income vehicles, they're tax deferred rather than in a taxable account. Now you're paying ordinary income tax on those. So portfolio construction and identifying your plan and making sure that you're either partnering with an investment advisor or getting good guidance on the investment selection is important, because you could design the plan perfectly, but if you just put the money in and don't invest it, you're not really getting the full benefit of what you're trying to achieve with those plans. So we spend a lot of time helping our business owners educate their employees on what the benefits of having the plan are, why they should be investing, how they should be investing within their 401k, understanding the open architecture of investing. Certain firms have open architecture on the investment advisor side and others don't. And it's just finding the right fit for you and someone that can help you manage those different criteria. We also help our clients, and we work alongside Tim and his team as well to kind of identify what are the benefits of having the plan. Obviously, there's tax deferral on the front end, and Tim would be a better resource than I, is not a CPA, but in Illinois, for example, when you have pension income, it's not taxed at the state level on the way out. So when you do have RMDs from these 401k plans and everything, you're kind of permanently avoiding the state level tax. Now, tax law could change, but in its current structure, you're getting tax deferral on the way in, and you're avoiding the state level tax in Illinois specifically on the way out. So making sure that you have the right investments, you're utilizing equities and fixed income appropriately throughout your entire portfolio really help drive benefit in these plans from our aspect. So again, that's something that we work with, and we try and educate all of our business owner clients as well as their employees who are contemplating participating in the plan or have the plan but didn't really look at it or didn't structure it properly or haven't had kind of a holistic review of their investment life. So we dive into all of that and kind of go through the entire planning process as well as investment selection.
For sure. And I just want to add something on the education front, Nick. For the business to get the full value of the benefit that they're providing to the employee, education is the key. Because in so many businesses, I see very little effort on the education front, and the participation rate on the employee front is minimal.
Yeah, I mean, it's a great point, Tim. I mean, we see this all the time where employers will set up plans. They'll obviously tell their employees about it, and they'll be contributing into it, but their employees not doing anything with it because it's kind of just out of sight, out of mind. And now they're just sitting on big piles of cash that could have been growing for them tax deferred. And that tax deferred compounded rate of capital over time can become substantial amounts of money. So we do a lot from an education perspective. So we have a number of educational series like your firm does here. We do a quarterly interactive call that all of our clients are open to join, where we cover economic information, investments. We explain what we see coming from an economic outlook. We have an educational series for younger clients of ours that are really just trying to explore and understand what's a taxable account, what's a 401k, why should I be using one or the other? How do they complement each other? What's an ETF versus a mutual fund? So we get as granular as that kind of level, but as in-depth as what is the difference between core fixed income, like an aggregate bond index versus private credit, and why should you have one or the other in your portfolio? So depending on the client and their knowledge base and their want and desire to understand how they can better position their plan, we'll get as granular as possible. But that's really only applicable or possible if you understand the plan construction and you're working with a Martin to help you construct that plan so that you have that self-directed option versus kind of the traditional route of, hey, here's an investment lineup, target date funds, and you get to kind of pick, and that's kind of all you get. We like the self-directed option, especially in smaller groups where we can really dive in and get granular with the education with each employee.
Right. Well, and sometimes employees are getting access to investment managers that they otherwise wouldn't.
Correct. Yeah. Sometimes, when you have this option and it's open architecture and you're building the plan, you can open it with, a lot of different custodians. You partner with a Vanguard, you could open it at a Schwab, or a Fidelity. The benefit with opening it with some of those other providers like a Schwab or a Fidelity is that you can hire any advisor out there that can work with those platforms. So we as a firm work with both of those platforms, have plans at all of those platforms that we help our clients manage. And that allows them to make this a seamless journey for them and their employees, right? They can house their taxable investment accounts and their tax deferred all in one place, be able to see it, manage it, understand what their allocation is, and not have to worry about logging into 3 different sites to see all of their investment accounts and strategies. And it also lets us build a cohesive one-stop solution with them, right? We can help them manage taxable and tax deferred and make sure that there's not redundancy and you don't own 50% NVIDIA in your taxable account and in your 401k account. And now you're overexposed to one company.
Yeah. I just want to, we're down to 5 minutes, but I just wanted to kind of double back on the efficiencies of certain types of plans. Martin touched on the ones that are free,
Mm-hmm.
Like the SEP, the simple, but in some respects, they're more expensive for a business because, there's less opportunity to kind of be more efficient on the contribution. But then one of the other costs is on the smaller plan, like some platforms are more expensive to the business and some are more expensive to the employees. Can you guys touch on that in some respects? Because I think that's something that the owner and the employee might not understand.
Yeah, I can hit on kind of the more simplistic plans and the cost, and then I'll turn it over to Martin to kind of dive into some of the 401k stuff. But when it comes to like simple 401ks or SEP IRAs, if you're going through, you're utilizing Martin to help structure it properly, and then you're using an advisor like ourselves to help open the account, fund the account, invest it. The custodians that we work with don't charge a fee to house the 401k, to open the 401k or the SEP IRA. It's just there, right? Your real cost is the funding requirements if you have multiple employees. But outside of that, it's really just hiring the advisor, their fee, and then, just picking the investment in the investment lineups. Obviously, there's different fees for more complex plans, which I'll turn it over to Martin to speak about just because he's going to have more familiarity with structuring those complex 401ks or cash balance plans.
Yeah, so typically what you're looking at from a vendor cost, if you're having your things that your investments at whether it's a Vanguard, Fidelity, American Funds, John Hancock, you're looking at a vendor platform cost in the neighborhood of anywhere between $1,500 to $2,200 rough plus head count. And it's so that's their record keeping type of fee. And as far as if you went with individual brokerage accounts, what most people don't actually get is actually it can be a lot less, basically inexpensive because, as Nick stated, typically there isn't a cost associated with an individual brokerage account. May be something de minimis in the $50 per participant, or a fee per an account. Where you're getting the cost on an individual brokerage account, maybe from somebody like myself, where I might charge a small fee for the accounting per brokerage account. But they're actually quite efficient when it comes to a cost standpoint.
Great. Well, we're down to a couple minutes. Just wanted to open it up, see if anyone in our meeting has any questions for Nick or for Martin.
Yeah, I just was thinking, are all types of businesses, is this available to all types of businesses, or are there some businesses that this is better suited for than others? And in terms of who the employees are?
Yeah, I mean, I think that it's definitely an option for all business types. It's just what is the right plan for your business type, more so than is there a plan for your business type. And I think that's where, I would encourage anyone who's thinking about this or kind of talking about it to talk to Tim, to talk to myself, talk to Martin, and kind of start to help build that foundation. Because you really do need a partner in deciding what the right plan is. I would always recommend partnering with a Martin or a Tim or an advisor, because they're going to help you get to the right plan. Because you can tweak plans, you can change plans, you can build the plan any way you want, but I think it's imperative that you get it set up properly for your business. Otherwise, you could run into some high costs or high funding burdens that you just weren't aware of.
And to Nick's point, I think you really just need to work the problem backwards. Find out what the owner's goals, objectives are. Is it 50,000? Is it $70,000 a year? What is the dollar they're wanting to put away? And then you can kind of figure out what is the design that best accomplishes that. So it really has to do with finding out what your goals and expectations are so that you can marry them to something that you're happy with. Because if you're not happy with the plan, you're not going to embrace it. It's not going to be successful. Just like your business, you want to make sure that you're giving something 100% and put your best foot forward.
Right. Well, and I just want to close with, for the employees, it's a great benefit. For the business owner, it's also a great benefit. The idea is, you're doing something every year. So the important thing is that you start. And to be competitive in a tight labor market, you have to have good benefits. And this is one that doesn't cost as much as business owners think, especially with the credits that are available to offset the costs. And, from an ownership standpoint, you're carrying a lot of risk running a business. And so at a minimum, you need to be advancing your potential to retire. And this is one of the most efficient ways to do that. So, well, I want to thank our special guests and everyone that joined us today. Again, we're going to have this recording available on our website like the other ones. Thank you, everyone.